All attendees are in listen-only mode.
Hello, everyone. This is Chris. It's April 3rd, and welcome to our monthly Premium Members Connect series. Kind of wish it was April the 1st so I could pull some funny jokes, but that was just the other day. So hope all of you had a blessed and wonderful Easter holiday, the 3-day holiday. Also, I want to apologize for a little bit of an email snafu on my part. So maybe that was an April Fool's joke. So anyway, let's go ahead and get started. And just a reminder that the power of the pattern, our intent is to be your 30-second solution to empower you. That our reports may be multiple pages long, but at each given chart you can look at it. And my hope is that I try to keep it not too busy, and they can be simplified, and you can see what action to take. And again, as doing this personally and professionally now for 38 years, the most important thing in all trades is not the upside target, but it's the management of principle and the risk parameters. I believe that the power of the pattern gives all of us. To me, is a lot of comfort in putting my head on a pillow at night. It's always refreshing to know, hey, here's where the line is in the sand. If we take a trade, we know where we walk away from a risk management perspective, and especially kind of in some of these times that we've seen over the last 60 days, why that's important. Always as a reminder, I'm not a bull or a bear. There's opportunity to make money on all sides, and there's opportunities to make money in cash and then let markets drift down to where we can buy them at better prices. So I don't want anything poorly to happen to the economy, but if stocks happen to sell off and create a discount, just like some of you may open up a newspaper and hey, something at the local Walmart store, whatever's on sale, and you go take advantage of it. Let's just look at the markets, in that same fashion. We started last month. We had a lot of fun and some good response with it. We're going to keep it up. We're doing it again today. We got a few giveaways during the presentation itself. So just as a reminder, most of you probably have a little box, a little rectangle in the upper part of your screen. And if you would hit the orange arrow that's facing to the left, it will push this box out. And as we ask a question, just a reminder to put your answer into this little question section where the red arrow is. And we're going to do it a little bit differently this time. We had really a good response and a lot of fun last time. And thanks for your response and excitement and quick responses and good answers. This time we're going to get a hold of you primarily after the webinar. So Rick's got a lot going on, everybody. So just get him the answer, and Rick will be watching things. We'll pick up the first one that answers correctly or closest to. There's going to be a couple of them that we're going to give you a hand grenade closest to, the first one closest to. But anyway, this is how you can respond if you want to participate in the quiz. So as we shared a month ago, hard to believe we're into the first quarter is behind us. 1 month ago was the 1st of March, and we'd come off of a really wild February, if you remember. Started off at a high, quickly declined 10%, then shot back up and closed the month of February almost back at the highs of the beginning, which we'll discuss formed some very rare patterns on a monthly basis. But as a reminder from a good friend, Ryan Dietrich, this is the seasonal performance of the S&P. The blue bars are the S&P going back to 1950. The gray is the last 20 years performance, and the yellow or amber is the past 10 years. And so March and April, as you can see, back-to-back months are historically a couple of your strongest months. But as we all know, that sometimes seasonalities don't work. And March did anything but turn out to be the strong month that it has been seasonally. So as a reminder, April is typically fairly strong. And then we'll talk about it another time later in the presentation. But then we get into the so-called sell in May, go away, the 6-month window of the weaker prices historically on the S&P, or on stocks in general, excuse me. So That always doesn't work either. I think last year, if you remember, that wasn't a bad time to be long stocks, and we were long the majority of that time, and it really did well for us. But the takeaway from this slide is historically, April has been up, and Ryan put this piece together. When you look, this is each individual month's performance of the S&P. Then there's a little black line that zigzags back and forth, and that's the scale on the right, the percentage of times higher that the S&P has been in 9 of the last 10 years. The month of April has been higher, so you can see statistically that this was the best month over the last decade as far as the percentage of times higher, and it was the 3rd best month on performance overall. So as we ended the month of February and we were back on this rebound, I sent all members, Premium Sector Global Dashboard, a piece on that I thought, protection of or capital preservation was highly important. And I appreciate that we have many multi-year members on this call. Herbert from Canada, I'm really honored, from your renewal. I think you've been with us 7 years. John, you just renewed on your multi-year premium plan. My hat's off, and I really appreciate, that. Sonia, multi-year premium member. And for any of you that aren't aware, from a premium membership perspective, we offer nice discounts for multi-year membership. So in case you weren't familiar with what I was just thanking some of those people for, that you would like to be on board and even save more money, get a hold of Rick. But in the link, the reason I bring this up is even if you'd been a member from the very beginning of Kimble Charting Solutions, I think I can count on a couple of fingers times that I said capital preservation could be important. And one of the reasons that I shared this a month ago is that I was influenced by a couple of chart patterns that in my 38 years, it doesn't matter that I've been in it 38 years, all of us can look back on charts. We can convert your charting software to daily, weekly, or monthly, and we can all look backwards and be really smart, right? But the point was last month that this chart pattern took place that, I had lived through all these time periods, but I going backwards where we're going to talk about the monthly hangman patterns. And that was one of the main influences that we'll discuss in the next few slides, why I wanted to say, hey, capital preservation is really important right now, folks. I don't take that lightly. Like I said, for the long-term members, you don't hear that hardly ever from me. It's an outlier of an event. Haven't had to do it for years and years. And on the same token, I'm okay, folks, with having egg on my face if I bring up something that seems concerning or we discuss capital preservation and the markets rocket higher. I'm humbled by your membership. You pay good money to do this. But my goal is, as I've learned several times over the last 38 years, a lot of people get really misconstrued, I think, and how high can something go? How high can it go, Chris? What's the upside target? When the first thing that we all, you're going to learn over time that risk management is the most important thing. Hanging on to your principles so that you can play another inning, keep the ball game going is highly important. And that's why I put out that email. This is a time that capital preservation can be important. And so we'll go through and why was that said? So we've got a lot of new members, and I want to just kind of go back just for a second and look backwards. This is the Dow, and the power of the pattern looks for what we want to call as Emoto Points, and not emoticons, but Emoto Points. In other words, some really key highs and lows. And so, in my opinion, over the last 11 years, the two most important price points were the 2007 high before the financial crisis and the financial crisis low. They're highlighted at 1 on the left of the chart. And so as you can see that the markets in 2009, fell hard, and then they rallied over the next few years from 2009. We're rolling into 2013, and now the S&P is testing the 2007 highs, which this is the 161, this is the highs of 2007. and we applied the Fibonacci 161 level to the 2007 highs and the '09 lows, and that level came in on the Dow at 18,259. And so the thing that these are monthly bars. Most of them you can see most of the months during this rally, once it got above the 2007 highs, most of them are green. And it screamed higher from 1,300, or let's just round on the Dow, excuse me, let's round it to 14,000 and up to, then the rally is up to 18,000 when it first touched the 161 level. So it was a 30% rally, didn't take much time to get there. But once it got there, then we saw more declines. We saw a lot of choppiness, and we saw resistance. And once it could break above it, and it used now old resistance as new support, look what happened after that. So the market rallied 50% just in a matter of months. So the 161 level was important, and for those members that have been around multiple years, once this broke above, we started discussing the 261 level. And so this is the chart on the S&P, still doing the same thing, applying Fibonacci to the 2007 highs on the left and 2009 lows here. Once it broke, above the 2007 highs, there was a nice rally. I didn't put it in here, but here's the 161 sideways level. Then once it broke above that, it rocketed up. So in January, there was all kind of streaks that we discussed last month. Number of months without a loss was at an all-time record. Volatility was at a low for the longest period of time, and the records just went on and on and on. But once it hit the 261 level in January, things changed. That's when volatility had its record day, when the XIV product, blew up. So many streaks, came to an end, and then we started this world of choppiness. And that's where I started, writing that, when that time hit, capital preservation is key. Just pull back, relax, be patient, let this thing chop itself out. It'll end. For those strategies that want to use shorter term moving averages or use momentum, this is a dangerous window because this thing can go back and forth, and we've all lived it already now, for a couple of months, just this rapid choppiness, schizophrenic type, attitude. But as a reminder on the S&P, this is SPY, 285 is the resistance level, and still at this point in time, we started highlighting this over 6 weeks ago, that the 253 level is support, and that we wouldn't be surprised to see the choppiness, back and forth. So a similar application on the Dow. The Fibonacci ranges are 26,700 on the upside. Once it hit it back in January, stopped on a dime, reversed the 23,300 level, give or take, a few points, is the support zone. You can see now it's come down, and this is a monthly chart, and 3 different times in February, March, and so far this month, just even though we're a couple days into it, has almost touched this level 3 different times. So again, this is the trading range. Don't be surprised if these really wild moves and volatility we all know has picked up. This service is not designed to, enter on a morning and close that evening. It's not to be open a long position on Monday and close on Tuesday. If you're looking for a day trading service, this is not the place, to be. We're trying to get some more trends, trying to ride some things out, but we want to let you know that this is the type of back and forth that I wouldn't try to be too brave, in here. So again, I truly believe you don't hear me mention the president. You don't hear me talking about tariffs. You don't hear me talking about tweets. You don't hear me talking about South Korea. We're just talking price, folks. And I don't know why sometimes the 161 level can influence things the way that it did, or the 261 level. I don't look for excuses. I just try to call it humbly as it appears to be, and try to empower and inform you. One of the things that's interesting, this is a chart that you've not seen before, but on the bottom is on the top is the S&P, and on the bottom is the 52-week highs and lows from Fidelity. And one thing that I think is interesting is, a lot of people talk about, hey, if you see a lot of new highs, strength begets strength. So I still think it's interesting that when you look back, that the highest number of 52-week highs came right to an end when the 261 level was hit. So for some reason, these extension levels and these mathematics can just stop good things right on a dime, and they did in January. So, this is looking at kind of some of the main indices. What happened once the Dow and the S&P kissed respective 261 levels? It hasn't been terrible to the downside. I'm not into. We all know that some of the media services say if something is down 10%, that's correction territory, and then if it's 15 or 20, it's into a bear market. I'll let somebody use whatever adjectives and definitions that they want. These aren't terrible numbers, but the bottom line is you can see across the board, the Nasdaq tried to hang up here the longest. It actually got above the January highs for a couple of days, and then it's caught up to the downside, played a game of catch up. But you can see that since those highs, mid caps are off about 8, Nasdaq's off about 9, S&P 10, NYSE, which would be the broadest indice on this chart, is down almost 10.5, with the Dow down about 11. So for whatever reason, I do believe that the 261 level is continuing to influence the markets, and you can see how things really changed since then. It not only changed some of the indices, it changed the advanced decline line. This is the advanced decline line on a daily view, and you can see where I was highlighting with the arrow up there, even the advanced decline line that was just looking real Arnold Schwarzenegger strength. I almost want to choke on that because of Arnold had to have some emergency heart surgery, but I think he's okay from what I hear. But this thing was really rock and rolling, just really strong, and then as soon as the 261 levels were hit, things changed. We'll come back to the weekly advanced decline line, but I do want to say from one positive that I see from a bullish case, because the long-term trend still remains up. You'll notice that the daily advanced decline line, even though the markets have come back down to test many of the indices that we'll look later, the February lows, the advanced decline line has not went and done that. You can see it's still above a couple of times now. This would be the February lows that happened around, I think, February the 9th, but you can see that they haven't been able to break below. For the most part, they stayed above this level. So in little nuances, looking for micro positive, that's a positive message from the advanced decline line. So since the 261 levels were hit, to me, the predominant pattern that's jumping out to me over, what would it be, everybody? About 9 weeks or something like that, would be the potential that the Dow on the left and the S&P on the right are making descending triangle patterns. And for anybody that's not familiar, a descending triangle pattern is characterized by lower highs and flat bottoms. So both of them have made lower highs inside the respective ones where we have this gray arrow, but you can see that support is being tested at each two. And not only is the support being tested of the horizontal lows, if you'll notice, the 200-day moving average has also come in to the game at the same time. So the 200-day moving average is still sloping upwards. So we now have a dual support in play, which would be the 200-day moving average test and also the February lows, which are being tested right now. So these, what are the gray arrows? If you're not familiar, what you want to do is, this last year when the market was going up, you could see probably 8 out of 10 ideas that we shared with members that have been around now 14 months, in 2017 and going into January of this year. We looked for ascending triangle patterns, which 2/3 of the time lead to higher prices. An ascending triangle pattern is the opposite. It has a series of flat tops and rising bottoms. Now, from a statistical perspective, that pattern is more reliable than this pattern, the descending triangle pattern. But the bottom line is When these occur, it's not proven that this pattern is in play. I'm trying to empower you on possibilities. They take place at highs. They typically represent an end, not a long-term end, but a short-term end to the trend. Roughly, their statistics are about 60% of the time it leads to lower prices. And if you take the high of the pattern to the low, that's what these gray arrows represent. And if support would give way, what I've done is copy pasted those. And these are what are called measured moves. This gives you an idea that if support would break at each two, the downside targets of the Dow would be around 20,000, 20,050 roughly, and in the S&P would be 2325. So the bottom line is for those that are nimble and aggressive, if these support lines would give away, you'd see a break of the horizontal bottoms and the 200-day moving averages. The measure move would suggest that both of these indices would decline. The real close numbers around 12, 13%. So that would be a significant to give back. If you're long, that's why I've tried to say capital preservation is important. We'll go through what to me is the most likely continuation of this pattern, but I want to let you know that if the markets would slip below these levels, don't be surprised to see another, we're almost 10% off the highs. Don't be surprised to see another quick 10% disappear if the bottom of these patterns are taken away. So we'll take a break here from some of this and we'll have our first quiz. So for all of you that want to participate, open your bar in the upper right, hit that orange arrow and bring it out, and you can be ready to respond to the quiz. So I'm going to unveil the question here coming up, and here it is. What was the average length of time that a correction took from the 2009 lows to recover to new highs? In other words, if it was at a 1,000 level and then it declined, how long did it take to get back above that 1,000 level in the number of days? So the answer to Rick would be the average number of days of all declines since 2009 is X. I'll let you think about it for a minute and get the answer to Rick. Okay. So here's the answer. The answer is 200 days. So this is a chart from Bloomberg, and of the times that the market or the S&P had declined 10% since 2009 lows, they're in the kind of turquoise shaded boxes. You can see the average number of, or the number of days, excuse me, that it took to get back above the old highs and to new highs. And so you can see the different numbers. And so the average correct answer, or the average, was 200 days to fully recover. And so since the January 26th peak, we're about 60 days in. So part of the reason I just wanted to have some fun with this, but also just to share some perspective that when the market backs off some, don't be frustrated or don't get too excited that it's going to just go right back to those new highs. It sure can. I imagine a lot. I questioned it myself. We saw that real quick decline in February, and then rocketed back. We've been in this really upward sloping market, since 14 months ago or so, and it didn't do it. But it's understandable that to sometimes expect that, but it's kind of want to let you know that it can take a while for these things to work themselves off. So again, after the webinar, we'll get back and let you know. And just to let you know, for those who ever happen to win, I'm going to pass along a $50 Amazon gift card. So thank you for your participation, and I wouldn't be surprised we don't have another one coming up. So I wanted to kind of talk about one of the things that kind of sticks out to me as far as almost a sentiment indicator, and that would be margin debt. And when people get really confident about the stock market, they typically borrow money. And so this caught my eye as I was just doing some reading of late, and this is a U.S. margin debt. In other words, people borrowing money to invest in stocks over the last couple of decades. And you can see at one point in time it hit a high and then backed off substantially, almost declined 50%. And then people, they'd never do it again, right? After a 50% decline in the S&P, they wouldn't borrow money again, right? But they did. And you can see then in 2007, it went to higher highs, and then it backed off almost 50% again. And then here we are now at an all-time high. So a lot of people that have missed out on the market rally, we were long and strong, all of last year going into January of this year. That's when we pulled up our stops the tightest in January due to the 261 level. But a lot of people, I believe, were really anxious. They didn't even participate in the upside because of statistics like this, the margin debt. Hey, it's too high. I can't afford to be long. So this came from a good friend, Doug Short, and an Advisor Perspectives. And this is a little busy chart, but let's just kind of look at it for a second. It's not as busy as you think. But the blue line is the S&P, and it's going back 20 years. And the red line is margin debt, but inverted, just so you can get a perspective of the things going and working in the opposite directions. And so in 2000, you see when the S&P was at a high, you can see an inverted margin debt. In other words, people borrowed a lot of money. There was a fairly decent spread. And folks, the main thing to watch for with the margin debt is not the level where it is. It's like with this inverted chart when it starts moving higher. Or in other words, if I didn't invert this, in other words, when people start getting rid of margin debt is typically where the market gets in trouble. So don't get confused that margin debt by itself is bad. Just watch for when it's high and then it starts pulling back. That's when markets can tend to sell off. So you can see the spread in 2000 highlighted and in 2007. Then you can see the spread now. And this is one big puppy of a spread. I have fun. I would like to call this a fish mouth spread. That sometime this thing's it's gonna narrow, and I don't know when that's going to take place. The statistics, everyone, on the margin debt, to my understanding, come out once a month, around the first of the month, and so it's not something at mid-month. I could ever show this to you. This is just something at the beginning of the month. But you can see there's a small little bit of rise, or in other words, a little bit of shrinkage of margin debt, and you can see the market is backing off a little. But if we see this starting to come together, and especially come together very quickly, I think the bullish case is going to be challenged, in stocks. So I just kind of want to empower you that oftentimes people throw out that debt is bad, and I know it can get people in trouble. You notice that coming from me, I don't suggest trying to lever up on 2x or 3x ETFs. My thought on borrowing or leveraging up, it just makes a bad decision 2 or 3 times as bad. So it's you just don't have to do it to be successful over the long run. So one of the things that I just kind of, where we're staying with the margin debt is, this is from Movement Capital, is a margin debt filter. In other words, just trying to look at it, it's not about margin debt being high, it's about margin debt shrinking and coming down or narrowing or crossing the zero line on a 12-month rate of change. And so you'll notice that this is the S&P in black, but when the rate of change crosses the zero line, you see it goes from purple to teal color, the filter would just say go to cash. And then when the margin debt would go back above zero on a 12-month rate of change, it'd be time to get back long. And so you can see over time that this has worked pretty well. But one of the points that I wanted to bring it up is right now margin debt has not changed enough to flip the trigger to say go to cash. You can see it's still a good bit above this. And so again, staying in this theme, and this is the last slide along here, margin debt is high, and if we would see it move towards the zero line on rate of change, in other words, it starts shrinking, that's where the margin debt could be a signal for further capital protection of your assets. So moving on to the chart that we try to put really close to the start of each webinar, because to me it's just so important. It's the advanced decline line. It's the lifting up of the hood and looking, underneath. And so since 2009, the advanced decline line has remained inside rising channel 1, which sends a bullish message to stocks. And the trend is still up, everyone. We've continued to highlight and share the similar message. It did hit the top of the channel in 2014. Not a surprise to me. That's when the 261 level was hit that we talked about early in the webinar. And as the 161 level kept the market in check, you see the advanced decline line struggled to go much higher. Then once it broke support, then it came down to, once it broke this rising support, at 2, then it came down to test the rising channel 1, and then it's been off to the races since 2015. So it did hit the top of this rising channel, and that's where, the message that I apologize if I've tried to advocate and stay true to the same message for the last few months, is I wanted to point out places that the bulls did not want to see selling get started. The trend was up. We've not said that the long-term trend has changed, but there are certain price points, at the top of channels that become dangerous if that's where selling would start. And so the same thing with the advanced decline line. The trend is still up, but you can notice there's the blue horizontal line and the red upward sloping line coming into play at 3. So right now there's still a positive message coming from the AD line. As I shared earlier, it's still above the February lows, but if it would take out dual support at 3, it would send a cautionary message to the bullish case that hadn't been seen in a few years. So as you know, every week I update this in the Global Trends Report because I believe it's very important. Nothing alarming or really negative. This is one of the reasons that I've tried to discuss capital preservation, but I haven't tried to discuss shorting of stocks. I'm completely open to short stocks, but when the advanced decline line is still sloping up, the odds of being successful in shorting the broad indices or different things are greatly reduced. But if we start seeing this advanced decline line start really heading south and breaking support, for those that are more inclined, the first goal would be capital preservation. Just don't lose money because you're going to gain money in purchasing power. But for those that would want to short stuff, this would be one of the triggers that we'll discuss later that you want to watch closely for, that would set up the theme that maybe now could be a time that you could make some money on the short side. Just real quickly, a couple of sentiment slides. These quick declines, and we're back down to the lows of 2018. What was hit on Friday, which was the last day of the quarter. We've been up the first couple of days of this week, but this is the CNN Money Fear Greed Index. You can see that it's now at 8, which is pretty close to as much fear as possible, in the marketplace. And so this could be, don't be surprised to see swift bounces. The billion-dollar question for all of us, is this time to buy the dip, or is it better to be selling the rallies? And this trading range that we're in so far, I don't believe it's given any of us really the great answer to that. So if the February lows are broken, I think then you get a clearer answer of what to do. So sticking with the sentiment theme, this is the Sentiment Trader has like 31 different indicators, looking at indicators that express excess optimism and excess pessimism, and then they take a spread. And you'll notice that, when this is high, their idea would be markets are closer to being overbought or potentially highs. And when they're low, markets are typically oversold and closer to lows than highs. You can see a few of the green bars, that some of the lows in 2011, which was one of the first large declines off of the 2009 low. And then after the Fibonacci 161 level was hit, you see these lows were also joined by this spread being very low. And so the thing I want to point out is why I brought up, is this a buy the dip or sell the rally mentality? You'll notice that there was a lot of times that this indicator was very oversold for a couple of years, friends. and yet the market wasn't at a low. So price becomes so important to stay focused on. I do believe that we should always look at sentiment and don't throw the baby out with the bathwater. But I just want to kind of let you be careful with some of the sentiment indicators because they can remain oversold, but it doesn't mean the market stops going down. You can see this puppy was deep into oversold readings many times through here, but when you look above, market just kept going down. So definitely oversold, do a bounce, but we got to be careful with these type of indicators. So right now, I think the pattern, these are daily charts. The first chart is the S&P, starting from the left. The second one's the Dow. The third one's the NYSE. And the fourth one is the Dow Transports. You see the blue horizontal line representing support. You see the lower highs with the red lines. Earlier, we discussed descending triangles. My best bet here is that since they're still above, or 3 of the 4 are above the 200-day moving average, that's the kind of the red squiggly line coming in here is the 200 MA. I wouldn't be surprised to see a rally. The key to this pattern, if it's true, if these descending triangle reads are correct, it's what happens when the markets kiss the underneath side of falling resistance. So from a bullish perspective, the best way to blow up any negativity of these patterns is to break above the falling resistance, which throws the descending triangle, out the window. But if the read would be correct, we would see some rallies go up to the underside of falling resistance, and then end up breaking below the horizontal support. As we shared earlier, the measured moves would suggest at least a 10% decline below support. So why I think it's so important, these descending triangles and knowing where that support is, we now went from a roughly 60, 90-day chart to a 120-year chart. So just to keep the, excuse me, I think it's so important to see the 30,000-foot view. We just looked at the really micro view, and now we'll step back and look at the long-term view. So again, this is over a century's worth of patterns on the Dow on a monthly basis. Since the early 40s, in the blue shaded area, the Dow has spent the majority of the last 70 years inside rising channel A. And there's another midline that goes through this channel. This one, it's a parallel line at the top and bottom. And you can see that even 1987 seemed to be influenced possibly by that line. And then you see that it banged on it for a few years. And once it could get above, it used the support. And then there was your 90s rally. But we're back at the top of the channel, and momentum on a monthly basis has not been here very many times. And the highlighted years of 2007, 2000, 1987, and 1929, those years were highlighted because that's obviously where important peaks came in, and also where momentum was close to the same levels as we are now. So in January, as the 261 levels were being hit in the Dow and the S&P, the top of the 70-year channel was hit. And so this is a blow up of this box right here. And so there's January, excuse me, there's where the 261 level is hit. And then you can see that it's reversed lower. So the most important takeaway of this is that overhead resistance is still there, and roughly the 27,000 range. But rising support now over the last couple of years is coming into play, which you can see also would be the bottom of that descending triangle. So not only from a 60, 90-day window is the markets, when they opened up yesterday, the first day of the new quarter, at an important support test, you can also see it's the Dow's at an important support test over the last couple of years at 2. So this is a place that the Dow wouldn't want to slip from, with momentum this high. I'm going to go, I get a little choked up here as I look at this slide, but I'm going to go through and discuss a little bit of what we discussed last month, because to me it's so important for those of you that didn't see last month's webinar or just kind of hang with me for a minute. But I'm coming from to you from Salina, Kansas. This is a tornado alley map. This area shaded it in red. I'm a native Kansan. I love this state. Every state has its issues, and one of them is this time of year. Now, I will say, growing up and spending my life in Kansas, as I shared last month, there's this time of the year that when you go outside in the morning and you open the door, you probably, after living here long enough, you kind of know when the conditions are right that you could have a tornado. And I will say today, we're in the window of time where tornadoes can happen. It's not happening today, friends, as you need a little warm air coming in, and we could use some warm air. So even though we're in the month of April, I think we're to get down to 19 degrees tonight. So I do know that we're not going to have a tornado, but it takes certain conditions. This is a nice map. It takes cool air coming off the Rockies coming into the middle of the states. It takes a cold front. It takes warm air coming off the Gulf of Mexico through Texas coming up here. And when those collide, you get one of the most beautiful and destructive storms. And the whole reason I bring this up is it takes certain conditions to create that storm. And in the month of February, the conditions seem to have taken place to create a pattern that's could be not proven, could be highly important to the long-term trend of the stock market. And as we discussed last month, and we'll go through a few more charts, in the month of February, there's a possibility of a hangman pattern taking place on a monthly basis. And to get a hangman pattern, you need to have an opening, which let's just call it at 100 level. And then you would have a decline. And then during the time sequence that you're looking at, it could be a one-day chart, it could be a weekly chart, and it becomes even more important if it's a monthly chart. And so in the month of February, the month began at a high, it declined a quick 10%, roughly in that range, and then it came back and closed near the high. And in my 40 years, 38 years of being in the business, these patterns are really rare on a monthly basis. It takes almost just perfect conditions to start out the month at a high, to have a decline, and then end the month at a high. And we'll find out in February if it was very meaningful or not. But no matter what, they're on the charts. And as a good friend of mine for 20 years, he says, Chris, it's always going to be on the chart. It's not going to disappear. And so it'll always be there as a reminder. So here's just a quick look like at the S&P. I'm going to highlight the highs in 2007. There was a hangman pattern at the high of 2007 before a significant decline. So then this is the chart that I shared 1 month ago, just as a reminder. There's the pattern that took place in the month of February. And so you could have a hangman pattern, a topping pattern right at all-time highs. So just an update. So that was a month ago. Here's an update, but I also wanted to show you, here's the S&P going back to 2000. And in the high of 2000, you can see a monthly hangman pattern here and here, two different ones. And then here was the one that we just looked at in 2007. And here was, because this is a current chart, there's January in the green, there's February, March, and then so far in the month of April. So we can see that there was a February hangman pattern. Now, a good friend of mine and a premium member, he wrote me an email a couple of weeks into February. He said, Chris, I think you need to get ready to, share that the hangman patterns were noise, that they weren't meaningful. And what my case that I want to make is typically, and why I'm sharing these two different time frames, sometimes it takes a while. And it takes a while to show that they are meaningful, and it can take a while to show that they're not meaningful. So I don't know humbly yet, everyone. The markets have continued to decline since the end of February, but I can't humbly say that, yes, those highly significant hangman patterns are for real, and we're heading significantly lower. It's very possible, but it's just not in the cards so far that we know that. This was a chart I also shared in 1 month ago's premium webinar. This is the bank index, the BKX, on a monthly basis. Right before the financial crisis, here was a hangman pattern that took place at the very highs at number one. And then we saw this ETF or this index collapse, what, 85, 90%, almost like tech stocks did. And then what has my attention, there's the month of February, a hangman pattern taking place at 2, which took place at the same level as the hangman pattern in 2007. So here's an update of that pattern. There's the hangman right here in the 2007 highs, and then we saw it tried to come back and made almost like a double top and then fell hard. You can even see that it tried to break above that after the hangman pattern. There was a reversal, and then it was off to the races to the downside. So, you know, do we have a deja vu case going on? Is history just repeating itself, just going in a circle here? It's possible. We don't know. But there's the monthly hangman pattern that took place in February. And then you can see banks, they were holding up pretty well, and then they had a real rough, this is the month of March, and here we are. So banks are actually, on a monthly basis, they're below the February lows and a little bit below this rising support line. So banks, as we all know, are really an important piece of the whole puzzle. So we're going to continue to watch them, but these hangman patterns have taken place. I don't think I threw the chart in the Dow, in the S&P. We see it in the banks. Here's the hangman pattern in the Nasdaq Composite Index taking place right at the top of the 15, 18-year rising channel, at the top of channel 2, at the top of channel 3, right here. So it's taking place at a significant price point. That chart was last month. Here's the update to it. The thing that's just quirky to me, and not a darn thing is proven, but the high in 2000, in the year 2000 took place March 10th. 9 years later, the low at the 09 lows took place at March 6th, and which was the first complete week in each of those months. And so far this year, the Nasdaq high took place at the top of this rising channel on March the 9th, and this is a blow up of this price action right up here. And you can see then after it hit it actually poked its head a little bit above that long-term channel. Then this would be an island reversal pattern. Now this is on a weekly basis, so you don't see the hangman pattern here, but you see that reversal and then see it heading lower. So big support test is in play. And it's really quirky to me, and it could be totally noise and absolutely meaningless, but it's just really sometimes the math is odd that you have 9 years down to almost the exact week, and then 9 years up to the exact week at the top of this channel. So we have seen a reversal. We've seen, obviously, for maybe one of the first times since the acronym FAANG has come along, the first F in FAANG is Facebook, and we've seen a lot of negativity toward Facebook that I'd venture to say we haven't seen that kind of negativity towards any of the FAANG stocks to that degree. And then not telling you anything new, Amazon's taken a barrage of issues of late, and it's had some selling pressure. And so it's interesting that all of this stuff takes place right up here at the top of these important channels. So we saw it in the Dow, we see it in the Nasdaq, we see it in the bank index, and it's also the hangman pattern is taking place in the transports. At each one was this is transports monthly. Each time that took place, at least 29% declines took place in the transports. Then we saw in the month of February another hangman at 2. Here's an update on that same pattern, and you can see, excuse me, similar to banks, transports are testing rising support at the same time. So time for another quiz, and it's a hangman quiz. And I don't think it's going to be that tough for anybody, but open up your boxes, and here comes the question. And the quiz would be, what was the average S&P 500 decline when it made monthly hangman patterns in 2000 and 2007? YouTube. Probably one of the easier ones quiz that you're going to have. Just give you a couple more seconds. And so we'll move on, and the answer would be 50%. That was the average decline when the monthly Hangman patterns took place in 2000 and 2007, the S&P. So I'm going to get off my bandwagon on the Hangman on this chart. This will be the last time that we'll mention it today. I still think it's going to take a while to answer this. But this is the Semiconductor Index, which is the ETF. The symbol's SMH. And this is on a monthly basis. And any of you who've been members, we know we talk about bullish reversal wicks and bearish reversal wicks, or bullish reversal patterns. But if you can see right here, back in 2000, you can see a heck of a, when you see this, like it's upside down hammer, or this long elongated pattern. This was a huge bearish wick, which happened to take place at the 2007 highs. So when those take place, that's typically a bearish signal. And you can see the ETF was trading roughly around 100 at the time, and then it ended up by the 03 lows around the 20 level. So there was an 80% decline. But in each of the ones were monthly reversal patterns that took place. And they were followed by significant declines. And then you can see from 2009, there was, for the most part, an absence of these bearish reversal wicks, but there was actually a few bullish reversal wicks. And lo and behold, they took place almost at one horizontal price zone in the mid-40s back in 2014 and 15. And then once that third one took place and it took off, here it went from 60 up to 100. So, you know, that's almost what a 60-some% return after those bullish wicks. But the thing that sticks out to me, two things that really do, is there is a giant monthly Hangman pattern right here that I'm highlighting. So that would have been in the month of February. And then this was last month in March. And so you can see that this is the largest reversal pattern, bearish reversal pattern, since right here in the 2000 highs. And it took place at the 2000 highs. So we have a possibility of a Hangman reversal and a bearish wick in the following month. So as most of you know that have been members for a while, we have talked month after month after month the importance of what the semiconductor index does. If it breaks out above the 2000 highs, you can see that it tried it in the month of March, only to see it reverse, but there's all the possibility that it could reverse still and break out above 2000 highs. That would be one of the more bullish signals that you could get. On the flip side, you wouldn't want to see semiconductors start breaking down, especially following these type of patterns. So the takeaway on this chart, and to finish for the most part on the Hangman, is this is like the last pattern on the earth that a bull would want to see up here at these highs, which was last month, was that giant reversal pattern. So we'll see in time, but from a chartist perspective, that has a potential to be pretty ugly. So as the Coyote in the Roadrunner cartoon, he always seemed to be doing something wrong and thinking he's going to get the Coyote and get him blown up. You know, I'm not trying to find any solace in the Hangman patterns. You know, and like I said earlier, folks, you know, if the Hangman patterns, you know, how can these be blown up, and they could these be a waste of my time sharing them with you, and it'd be nothing more than the indices breaking out to new highs. And that could negate any of those possibilities of the patterns. We're not that far from it. You know, if we're in the supposed correction territory of 10% down, I know math doesn't work exactly this way, but you know, if the markets would rally 10, 12%, they could be back to all-time highs. And then the potential monthly Hangman reversal patterns are negated, and they're meaningless, and this was a waste of time. But I'm completely comfortable with wasting your time, because if these aren't a waste of time, capital preservation that we started discussing before these declines will be highly important. So we discussed FANGs, and so this is Facebook in the upper left, followed by Amazon and Apple on the top row, Netflix on the lower left, Google, and then the S&P. So that they're all still in upward trends. In the upper left, you can see Facebook is testing a couple of triple support that bulls wouldn't want to see give way. This is about the time, somewhere right in here, we see some weakness in Amazon, the president sending tweets out to that. I don't think it has anything to do with the president. I know that's going on a lot in the news because this rising channel was hit before a lot of that took place. You can see Apple tried to break to new highs. You can see a reversal wick there, and you can see some softness, but it's still above rising support. So is Amazon. Netflix has been a little weak, still in rising support. Google would be one of the weakest of the FAANG acronyms. And then you can see the S&P is testing the February levels here. So for the most part, the long-term trends on the FANGs are still up, but definitely we've seen weakness in these areas, and it's all been taking place after the 261 fib levels were hit in January. So just as a reminder, in our the global 9-pack, we've got the S&P in the top row, in the middle is the Dow, upper right is the Nasdaq. We have small caps, mid caps, value line geometric, lower level is Germany, the DAX, France in the middle, with London in the lower right. And again, these blue circles, they're all still in uptrends, but as we've tried to express many times the last few months, these are price points where the bulls do not want to see selling get started. And we've seen a little bit, but not any long-term breakdowns. But why I say bulls don't want to see selling get started, because they're at the top of these rising channels. Bulls want to see breakouts, not weakness. So I'm kind of wrapping up a little bit on the 261, the choppiness, situation. Until the 261 levels are taken out to the upside, my game plan to you would be keep thinking capital preservation, keep cash levels high, trade infrequently while we're in this tight range, trade small when attempting to trade, and keep your stops tight. I think shorting could likely be profitable. I haven't mentioned it to any degree so far, but it could be likely profitable if the February lows are taken out, if the 200-day moving average gives way, and the advanced decline line also breaks below the February lows. So I'm not inclined to try to encourage you to go short. I don't know each of your individual risk levels, but for those that, the most important thing again is capital preservation. If there's ever a day to be short, I want to see those things take place. And then the last little bit there at the bottom is our patience will be rewarded. When the Dow broke above the 161 level in 2015-16, it had taken quite a few months of choppiness, but once it broke above it, it rallied over 50% in a little over a year. So these patterns are going to come to an end, but just be patient with yourself. Let this choppiness, let other people lose money and get the heck beat out of them, and then we'll take action on the breakout or the breakdown of the sideways action. So moving on from stocks to commodities overall, I want to remind you of the possibility of a long-term cycle. I'm not a huge cycle fan, but this is kind of something that there's a possibility. This is the Thomson Reuters Equal Weighted Commodity Index going back into the 60s. And it seems to be, we've just been years and years down in commodities. And so that's what kind of made me want to look into the cycles. And you'll notice that every 16 years, a few times there's been a low point for roughly 8 years up and then 8 more years down. This one was fairly mute, but there's a possibility of a low here and a low 16 years later, then this big push up where we saw the peak in 2011, and then we've moved down. And so there's a possibility from a cyclic perspective, but erasing any cycle, perspectives, keep in mind that the commodities are still above rising support off the 2001 lows, and they're also in this 7-year falling channel, and they're in a jam. It's essentially a pennant pattern that something's got to give. And so if we would see commodities break to the upside, it could reinforce the possibility of owning commodities that have been in the doghouse for years. You want to have some oil exposure, some basic material exposure, and potentially some metals exposure. But we need to see a breakout at 1. And so I'm going to kind of zoom in a little bit more. This is the same pattern with the cycle. You can see that for the majority of the last 30 years, commodities have spent the majority in rising channel 1. They spent the majority of the last 7 years in falling channel 2. It's at the 23% fib level. And so this is a monthly basis, everyone, and there's last month. So you can see it's now spent a few months right at this key level and not made much progress, but that is a potential of a bearish reversal pattern. Just hang on for a second, everybody, okay? So this is crude oil. Apologize, it's a little busy here, but it's to me, it's the most important commodity on the planet. And this is crude on a weekly basis going back 20 years. The bottom line is spent the majority of the last 8 years inside a falling channel A. I took a parallel line of A and placed it right here. And you'll notice crude came up a few months ago and hit it, came down and came back and hit it again. Here is the superimposed look. There's a potential double top and rising bottom. You can see that momentum is very overvalued here. So to me, the takeaway would be is if the commodities are to break out of the 7-year falling resistance, this needs to double top to fail and break out to the upside. So you can see that there's little wiggle room between this inset piece of 1 and 2. And so if there's a breakout here, it'd be really positive for the oil complex. Right now, there's a massive bet that crude oil is going to go higher. So it's a very crowded trade. So with momentum this high and this rising support over the last couple of years coming in, crude bulls would not want to see support break at 2. So again, this has a potential, everybody, of being a bullish ascending triangle, flat tops and rising bottoms. So this could go a long way to determining overall commodity positions. If it would break out here, had a good member did a good trade. He was sharing this morning or in the last 2 days on Exxon, the symbol XOM. Bought some calls. Great job. But if this would break out to the upside, different plays would be USO, which would be the crude oil ETF. You could do XLE, which is the S&P Energy ETF, or there obviously could be some individual oil stock names. So a big test of resistance is taking place with lofty momentum. So go ahead and open up your little box again. We'll have our third quiz of the day. And that quiz would be, how much did the XAU index, which is the gold and silver mining index, how much did it outperform the S&P from the year 2000 to 2008? So again, how much better did gold and silver mining stocks do better in the 8-year window from 2000 to 2008? I'm sorry, my Jeopardy music died. So again, this will be closest to. This number might surprise a few of you. Just give you a few more seconds to get stuff to Rick. And thank you for your participation. So here's a chart that compares the XAU index on top to the S&P 500 from 2000 to 2008 from a performance perspective. And you can see the S&P from 2000 to 2008 was essentially flat. But the gold and silver index picked up a lofty 350%. So we had a member ask us earlier, this week that if the markets would happen to turn around and if stocks would sell off and mining stocks would do well, what has happened in the past? And so I thank you for that question, and the quiz that was kind of derived, from that. So I don't know if this is the time, but I just kind of wanted to share as a reminder, this is the silver and gold ratio. And when you're bullish metals, you want to see this ratio heading higher. And that's anything but what's been happening since 2011. This is where Right here is 2011, so it's been heading south for 7 years. And this is one of the key indicators if you want to back up the truck and be long metals. At this time frame, the ratio is still going down, folks. I'm not a bull or bear on metals. I'm just open-minded to things that have done poorly and maybe they have a chance of rallying. Last month our quiz was what was the average gain when this ratio was at the support line and it turned up, and the answer was 200%. So there's a big test of support at 2 that's going on, but we're still not getting a positive price message coming out of this ratio at this time. But if this ratio, there's a chance, as a bullish falling wedge with the apex at support, if it would break out, sorry everybody, if it would break out at 3, that would be a positive signal towards the metals complex. So remain completely open to opportunities there. This is the metals 6-pack that I share each week in the metals report. Gold's in the upper left. In the middle top row is GDX. Upper right is GDXJ, the junior miners. This is the GDXJ GDX ratio, gold dollar, and the silver gold ratio. And you can see in the top, it's been pretty much just a rocking chair, folks, just keeping people busy going nowhere. So when the trading ranges are fairly tight, if you're a day trader, that's perfectly fine to try to take advantage of that when we're trying to look at some more intermediate term trends. This doesn't interest me a lot, but these channels are going to end, and I believe in my heart because it's a fact that the longer sideways channels, more time they spend in those, when they finally break out, it's a very big move. It's a bigger move the longer that it takes. So the longer this goes nowhere, which has been almost a year now for GDX and GDXJ, the opportunities could really be big if they would happen to break out to the upside. GDX, you want to also, for the miners, you want to see this ratio, GDXJ, GDX breaking out. This is a weekly chart. It tried it a couple of weeks ago, and then you can see that reversal wick, and then it wasn't able to break out. You see a reversal last summer, and then we see some weakness, and so we see that the metal shares selling off. You want to see gold stronger than the dollar. You can see a couple of weeks ago a reversal wick at the top of its multi-month, 3 or 4 month trading range, and now it's back at support. So if this would break down, that would send a negative message to metals, and you can see the silver gold ratio in the lower right continues to deteriorate. So not any real positives in the metals complex to back the truck up to the upside, but that's where I think that commodity chart, we're still in the commodity section, what the CRB does at resistance, what the crude oil does at resistance, and what the silver gold ratio does here will really tell us a lot about whether we should own commodities for the next, from now to the end of the year. Remain completely open to it. If you are to commodities, this is the commodities ETF DBC on a monthly basis. And you can see that it's up against resistance here at 2. And again, this is months, so this is 3 to 4 months where it's been kissing the underside of resistance. But I do have an alert set that if it would break out to the upside, I'm definitely interested in owning this. And then moving to the grains, this is JJG on a weekly basis. You can see that it's continued to create a series of lower highs for, oh gosh, folks, the last 6 years, and remains inside this series of lower highs. Kissed it. This is a weekly chart just about 6 weeks ago, and then backed off. We saw a nice reversal last week, but we're still below resistance as momentum's fairly high and possibly curling down. So I've got another alert set here. If the grains would happen to break out, it'd be an opportunity, but commodities continue to find themselves at a very important price point. So commodities can have a big influence over bonds and interest rates. Most of you know that there's just been so much talk about the bull market is in bonds is dead, and there are all kind of breakouts going on. I'm not into the definitions, but the bottom line is 10-year. This is a 10-year yield on the left, 30-year on the right. These are both 25-year falling channels that both of them hit dual channel resistance a few weeks ago with momentum, one of the highest levels in years, and they've backed off a little. Has there been a big bond rally that's followed? No, it hasn't. But so far, resistance is resistance until broken. So yields, in my opinion, have not broke out. They're still below where they were in 2014. And if you want to call the bond bull market dead, and yet rates are lower than 2014, I just don't get that. But it's not an argument on schematics or any of that. It's just that there's a long-term trend resistance. If yields would break above this 25-year falling channel, I would encourage ownership of inverse bond ETFs. Or if you're long bonds, to definitely short your exposure. What is it? I believe it's a TBF or TBT would be different inverse bond plays. And we'll discuss those if we do get breakouts taking place. So this is a combination now, and getting right at the end of the webinar, is the Dow on top going back to the 1930s. You can see this, it's a 70-year channel that we discussed earlier. In the lower chart is 10-year yields. And the reason, folks, that you don't see anything from 1993 going left is software doesn't have data on that. So I apologize. We know interest rates did trade, but the software, this is the longest length, is still 25-year falling channel. But you'll notice that the Dow is testing the top of the channel here. And this is the highlighted blow up of above right here. And then yields are testing the top of a 25-year channel, and this is the blow up. So they're both testing support at 1. So the one thing that the bulls, in my humble opinion, do not want to see is both of these break support at 1. I think that would be bad news for stock bulls. So everybody this is a good 30,000, in my opinion, it's a good 30,000 foot view to see the jam that yields and stocks are in, and how both stocks and yields are testing rising support at the same time near the top of multi-decade multi-decade channels that they've been in. So some really important price points that, we had a webinar in February on multi-decade opportunities, and this is a reminder of the multi-decade setups that breakouts or breakdowns will happen and some big moves will take place. So just as a reminder, patience is a key to the element of success. Bill Gates has shared this, and I really believe that it is. That's why I just say capital preservation right now. I wouldn't be overly bullish and I wouldn't be overly bearish. I'm not. I don't think you should be bullish or bearish, but just lay back, let other people beat themselves up. You can see that any position I take is extremely small, and stops are tight. There's no reason to be anything but just patient and letting time and price go by. So as we're starting out the month of April, here's the monthly seasonal list of strong stocks. You can see that the median gain in the S&P over the last 10 years about 1.27%, and there's some nice gains in stocks on this list. So I'll be getting all of you charts on more of these. And I've sent this in separate cover last week so you could see this by itself. But I just kind of wanted to let me kind of reiterate Amazon, the average gain in the month of April over the last decade has been about 9%. And so we're going to look at that, and we're also going to look at Sherwin-Williams on this list with the average gain of 8.4%. So Amazon has been up 8 out of the last 10 Aprils, and Sherwin-Williams has been up 8 out of the last 10 Aprils as well. So we know that Amazon, unless you've been on an island or in a cave, has been weak, was above the $1,600 level. We're now is trading in the $1,300 range. But this is a daily chart on Amazon, so you can see from a shorter term perspective going back to October, it's testing dual support this week at 1 as we move into the first of a fairly strong month for it. And momentum is now at daily, oversold levels that would match it back when it was back here last summer in August. It's not about matching price-wise, but just you can see from a momentum, it's an oversold perspective. So I'm going to watch this closely. I got a couple of buy alerts, but if we see there is an unfilled gap up here on a daily basis that if Amazon would rally and fill that gap, it'd be a pretty good percentage gain. So I'm going to watch this one really close, but I just kind of wanted to do a Boy Scout perspective, get prepared. This may be something that we might possibly be purchasing. And then Sherwin-Williams that we just talked about, it's also sold off, was trading almost close to 440 a share. Today it closed at 394 a share. But you can see that's testing dual support, and as we highlighted earlier, the median gain for Sherwin-Williams in the month of April over the last 10 years has been a little bit over 800 basis points or 8%. Potential nice reversal pattern taking place at dual support. So again, I have another alert that if we see some strength, I'm open-minded to buying this. So sorry that I took a while today, but there's a lot of fun things going on. I hope you found this of value. For those of you that participated in the quiz, thank you. I like your feedback on it. I hope it's a little bit of fun. And each of the quiz, whoever the winners were, we'll be sharing a $50 Amazon gift card with you. So I just want to again say I'm humbled and honored by your membership. Again, this is my 38th year, and opportunities to be are really exciting on many different fronts, you know, everybody. So look forward to talking to you between now and next month, but we'll see you next month on our next Connect series in the month of May. Take care, everyone. Thank you.